3 NASDAQ-based covered call ETFs, 3 different issuers, Goldman Sachs, JP Morgan, and NEOs, 3 different ways of generating high monthly income, and if you ask most income investors which one is best, the answer you will get most often is the one with the highest yield. But in my experience, working professionally in investment management, the highest headline yield is almost never the most useful starting point for this kind of comparison. It is one metric of 5 that actually matter. And on some of the others, consistency, long-term sustainability, downside behavior, and tax efficiency, the rankings shift dramatically depending on which lens you use. Today I'm going to run GPIQ, JEPQ, and QQQI through all 5 of those lenses in a structured scorecard format so you can see exactly where each fund wins, where each fund falls short, and, most importantly, why I think all 3 of them carry a structural risk that most people investing in them have not fully thought through. Let's get into it. Before we start scoring anything, let me make sure the foundation is solid. All 3 of these funds are covered call ETFs built around the NASDAQ 100. They all buy the underlying equities, or a closely tracked version of them, and then sell call options on top of those holdings to generate additional income. The covered call strategy works by giving an option buyer the right to purchase shares at a specific price, called the strike price. The option seller, which is what these ETFs are, collects a premium upfront for granting that right. If the stock rises above the strike price, the buyer exercises the option and captures the upside above the strike. If it stays below, the premium is kept, and the process repeats. The income these funds pay comes primarily from those premiums, not from traditional dividends. The trade-off is permanent and explicit. You receive premium income in exchange for agreeing to cap your upside participation when the market rallies strongly. Understanding that trade-off is the prerequisite for evaluating anything else about these funds. GPIQ is the Goldman Sachs NASDAQ 100 Core Premium Income ETF, launched in October 2023. It holds a portfolio closely tracking the NASDAQ 100 and writes covered calls on a flexible range of 25 to 75% of the portfolio, adjusting based on market conditions and implied volatility. This dynamic approach is the fund's defining characteristic. The expense ratio is currently 0.29%, the lowest of the 3. GPQ is the JP Morgan NASDAQ Equity Premium Income ETF, launched in May 2022, making it the oldest of the 3 and the one with the longest track record. It holds an actively managed portfolio that loosely tracks the NASDAQ 100 and generates its covered call income through equity-linked notes rather than direct options writing. The expense ratio is 0.35%, and it currently manages approximately $33 billion in assets. QQQI is the NEOS NASDAQ 100 High-Income ETF, and it is the most recent of the 3 to launch, but already a recognizable name in the income ETF community. It writes NASDAQ 100 index options, not ETF-linked options, on approximately 75 to 90% of the portfolio, slightly out of the money. The expense ratio is 0.68%, meaningfully higher than the other 2. QQQI won the Best New Active ETF award at the 2025 ETF.com Awards, which is a meaningful industry recognition. With that baseline established, let us start the scorecard. Metric 1. Income level. This is where most people start and where most people stop, and the comparison is trickier than the headline numbers suggest. When you look at how each fund quotes its yield on its website or marketing materials, you will find 3 completely different numbers, and now, an certain in a spafin nas, under an upon, sokunan, and all 3 are using legitimate but different methodologies that make direct comparison difficult. QQQI quotes a distribution rate of approximately 14.1% based on its most recent monthly payment annualized. GPQ quotes a dividend yield of approximately 10.3 to 12% depending on the period, and GPIQ, if you look at its website, shows an SEC yield of around 0.5%, which looks absurdly low until you understand that the SEC yield calculation for covered call ETFs essentially ignores most of the option premium income, which is where most of the actual distributions come from. That 0.5% number does not reflect what investors are actually receiving. To make a fair comparison, you need to use the 12-month distribution yield, the actual total distributions paid over the past year divided by the current net asset value. On that basis, GPIQ's trailing 12-month yield is approximately 9.9 to 10.3%. GPQ's is approximately 10.3 to 10.7%, and QQQI's is approximately 13.5 to 14.4%, comfortably the highest of the three. The 12-month figure is the right methodology here, because 1-month figures are notoriously unstable, especially for strategies where premium income fluctuates with market volatility. The reason QQQI commands a higher yield is structural. It writes options on a larger share of its portfolio, typically 75 to 90%, and targets options that are only 1 to 4% out of the money, which generates larger premiums but also caps more of the upside. JEPQ writes at roughly 2.5% out of the money through ELNs, and the implied coverage of the portfolio, based on its distribution history, suggests most but not all of the portfolio is covered. GPIQ is the most conservative, 25 to 75% coverage depending on conditions, which is why its yield is the lowest but its upside participation is the highest. On pure income level, QQQI wins. It has delivered the highest 12-month yield, and its structure is specifically designed to maintain that premium. That lead is likely to persist. Metric 2. Income consistency. This is where the scorecard starts to separate meaningfully from a simple yield comparison. An income investor who is planning to use these distributions to fund living expenses needs more than a high average yield. They need to be able to anticipate what is coming. JEPQ's distributions have moved around noticeably over its lifetime, starting at approximately 55 cents per share, declining through 2023, and then partially recovering. The per-share distribution history tells the story of a fund whose income fluctuates with the options market and is not actively managed to stay stable. That volatility in per-share distributions is a real problem for retirement planning. If your income from a fund drops 30% because the options environment changed, your budget has to absorb that. QQQI and GPIQ both explicitly target distribution consistency as a management goal. QQQI adjusts the coverage of the portfolio, writing more calls when premiums are low and fewer when premiums are high, to smooth the income stream. GPIQ does similarly with its flexible 25 to 75% coverage range. Looking at the actual distribution history of both, they have maintained notably more stable per-share payments than JEPQ despite operating through the same market environments. I am calling this one a tie between QQQI and GPIQ, both significantly ahead of JEPQ. If consistent, predictable income is your primary requirement, JEPQ's track record is the weakest of the three. Metric 3. Long-term growth potential. This is the metric that income investors most often underestimate, and it is the most important one for the long-term sustainability of the income strategy. Here is why it matters. The income these funds pay is expressed as a percentage of NAV. If your fund yields 12% but the NAV is declining because the fund is consistently giving up more upside than it captures, then your actual dollar income is shrinking even though the percentage looks stable. You cannot buy groceries with a percentage. You need the dollar amount to grow. And for the dollar amount to grow over a multi-decade horizon, the NAV needs to at least keep pace with inflation, ideally appreciating meaningfully. This is where the structural trade-off of covered call strategies bites hardest. JEPQ has the longest track record, and it tells an instructive story. Since inception, JEPQ's NAV has risen approximately 65%. Not bad on the surface, until you notice that the Nasdaq 100 over the same period has risen roughly 50% without dividends and significantly more with them. That gap is the cost of the covered call cap. Even in one of the most favorable multi-year environments for Nasdaq technology stocks in history, JEPQ has given up a meaningful portion of the underlying index's appreciation. If you were taking out all the income rather than reinvesting it, the dollar value of your monthly payments would have declined from the initial level as the NAV appreciation failed to keep pace with the cost of the options overlay. GPIQ and QQQI both have shorter track records, less than 2 years of meaningful data in most market conditions, but the 2025 performance comparison is striking. GPIQ delivered a total return of approximately 21 to 53% since inception, including distributions, outperforming both JEPQ at approximately 4.5% total return in 2025 and QQQI at approximately 10.2%. The reason GPIQ outperformed on total return while paying the lowest yield is exactly what you would expect from the theory. By covering only 25 to 75% of the portfolio dynamically, rather than the near full coverage of QQQI or the implied full coverage of JEPQ, GPIQ retains more upside exposure when the Nasdaq rallies. The fund can participate in more of the monthly gain before the cap kicks in. For an investor reinvesting distributions, GPIQ and GPQ get the slight edge over QQQI on growth potential. For an investor taking out all the distributions, I have to be honest with you. None of these three has a strong case for generating a growing real income stream over a 20-plus year retirement horizon. More on exactly why in the concluding section of this video. Metric 4. Downside protection. Since QQQI's late 2023 inception, which marks the beginning of the period where all three have coexisted, there have been three meaningful Nasdaq drawdowns worth examining: the April 2024 drawdown, the July to August 2024 volatility spike, and the September 2024 pullback. In the April event, the differences between all three were negligible, less than 0.25% separating the best and worst performer. In the July to August period, GPIQ fell approximately 1%, more than both GPQ and QQQI, which both held up similarly. In the September event, GPIQ again fell the most, roughly 5.3%, versus QQQI at 4.8% and JEPQ at 4.0%. None of these differences are enormous, and the drawdowns themselves were relatively modest. But the pattern is worth noting. GPIQ's higher NAV exposure due to its smaller options overlay means it participates more on the upside, but also falls further on the downside in sharp market declines. GPQ and QQQI provide marginally more cushion through more complete options coverage that generates income regardless of market direction. I am calling the downside protection category a tie between JEPQ and QQQI, with GPIQ slightly behind, though the differences are small enough that in most market environments, this distinction is not likely to determine outcomes. Metric 5. Tax efficiency. This is the clearest scorecard result of all 5 categories and the one that most income investors in a taxable brokerage account are most likely to underweight in their analysis. The differences here are material. JEPQ does not write covered calls directly. It routes the option strategy through equity-linked notes, which are structured derivative instruments. The consequence of that structure is that all of the income JEPQ generates through the options overlay is classified as ordinary income for tax purposes, taxed at your highest marginal tax rate, which for many investors is 22, 24, 32, or 37% federally. There is no preferential treatment of any kind for this income. Why does JP Morgan use ELNs? Probably partly for operational reasons and partly because the ELN structure allows the options income to show up in JEPQ's SEC yield on the website, making the headline yield appear larger and more comparable to traditional dividend yields. But the after-tax return for shareholders in a taxable account is meaningfully lower than the pre-tax yield suggests. GPIQ writes options on ETF-linked products rather than direct index options, which means its option income is also generally taxed as ordinary income, similar to GPQ's situation for the options component, though GPIQ does benefit from return of capital distributions that provide some tax deferral. QQQI is the clear winner on tax efficiency, because it writes options directly against the Nasdaq 100 index, the NDX options, which are Section 1256 contracts. 60% of the option income qualifies for the lower, long-term capital gains rate, and only 40% is taxed at the short-term rate. For someone in the 32% bracket, that 60-40 split versus JEPQ's 100% ordinary income rate represents a difference of several percentage points in after-tax yield annually. QQQI also actively harvests losses within the portfolio to generate return of capital distributions, which defer taxes rather than triggering them immediately. And the stock dividends paid by the Nasdaq 100 holdings are largely qualified dividends taxed at the lower rate. The combination of these 3 tax management approaches makes QQQI meaningfully more tax efficient than either JEPQ or GPIQ for investors holding in a taxable account. One important caveat: QQQI's prospectus notes that proposed regulatory changes could affect the Section 1256 treatment of NDX options in the future. That risk is real and worth monitoring, but as of today, QQQI's tax advantage is substantial and should carry significant weight for anyone comparing these 3 funds in a taxable setting. Let me give you the final scorecard across all 5 categories. On income level, QQQI wins with the highest and most structurally durable yield. On income consistency, QQQI and GPIQ tie, both actively managed for stability, both significantly more consistent than GPQ's variable distribution history. On long-term growth potential, GPIQ wins for total return investors who reinvest distributions, with a tie between GPIQ and GPQ over QQQI for investors reinvesting. For investors taking out all income, all three have limited growth credibility over multi-decade horizons. On downside protection, GPQ and QQQI tie with a slight edge over GPIQ in the limited data available. On tax efficiency, QQQI wins decisively for taxable account holders through Section 1256 treatment, active tax loss harvesting, and qualified dividend income. The overall picture is genuinely balanced, each fund leads in at least one meaningful category, and no single fund sweeps the comparison. What matters most depends entirely on your specific situation, how much you need yield now versus later, whether you are in a taxable account, and how you weight consistency against growth potential. Before I close, I want to say two things that go beyond the scorecard because I think they are the most important context for everything we just covered. The first is about the environment these funds have operated in. All three have launched or built their reputations during a period of elevated market volatility and elevated interest rates, both of which increase options premiums and therefore make covered call strategies look more attractive than they might in a lower volatility, lower rate environment. If volatility normalizes and rates decline, which is not an unreasonable base case over a multi-year horizon, the yields on all three of these funds will likely compress. GPQ's income, which is already more variable, will probably fall first and most. GPIQ and QQQI, both actively manage to maintain consistent distributions, will likely adjust their coverage ratios to compensate, but in doing so will sacrifice more upside participation. The short track records of all three funds have been set in nearly ideal conditions for covered call income generation. You should not assume those conditions are permanent. The second point is more fundamental, and it is the honest professional conclusion that a careful analysis leads to. All three of these funds are built on the same core trade. You give up upside on the NASDAQ 100 in exchange for income. The NASDAQ 100 over the past 20 years has earned approximately 13.5% annualized. More than half of those returns, in fact, most of them, have come in short, sharp bursts where the index gained more than 2 or 3% in a single month. In 240 months, over the last 2 decades, the NASDAQ was up more than 2% in a month almost half the time, and up more than 3% nearly 40% of the time. A covered call strategy that caps monthly upside at around 2 to 3% misses most of those episodes, and if you miss those upside episodes while still participating fully in the downturns, which covered calls do not protect against, the long-run arithmetic becomes very difficult for the investor taking distributions rather than reinvesting them. Running that historical scenario, if you had missed every monthly NASDAQ gain above 3% over the past 20 years, you would have lost over 1% per year. Miss every monthly gain above 2%, and you would have lost over 6% per year, wiping out 2/3 of your wealth in one of the best decades on record for U.S. technology stocks. These are not funds I would build a retirement income strategy around as a primary vehicle. As income diversifiers, as part of a larger portfolio that also includes equity exposure without options caps, they serve a legitimate purpose. But as the foundation of a plan to live off dividends through a 20 or 30-year retirement, the structural mathematics are working against you. That is a harder message than most YouTube income ETF content delivers, but it is the honest one. If you found this analysis useful, the kind of professional-level framework that does not just tell you which headline number is biggest, hit the like button and subscribe. New analysis drops regularly and I keep the same standard throughout. Drop a comment with which of the three you currently hold or are considering, and I will address the most common questions in a follow-up. I will see you in the next one.